Hello and welcome to another video on US taxation. So in the previous chapter, we learned extremely important concept of tax residency status. We understood the difference between the US citizen, resident alien and non-resident alien. And we saw how residency determines whether you are taxed on your worldwide income or only on your US source income. Now that we know who you are for the tax purpose, the next logical question is because even after residency is determined, two taxpayers with the same income can still pay different taxes. And why is this so? The answer lies in the filing status. Filing status determines which tax brackets apply, your standard deduction, eligibility for various credits, capital gain threshold, income phase out limits, and various other deduction which applies differently basis the filing status. So in simple terms, residency defines your tax world, filing status define your tax structure. So in this chapter, we will break down what filing status means, why it matters, the five federal filing status categories, the tax characteristics of each, strategic planning consideration, and by the end of this chapter, you will understand how filing status can significantly impact the final tax outcome. So with this, we'll move to the agenda of this chapter and look at what we're going to cover. Okay, so the key agenda items that we're going to cover as a part of this chapter is we are going to understand what is the filing status. We'll understand why filing status matters. Overview of all filing status categories. Uh, we'll do a deep dive into the filing status of single, married, filing jointly, married, filing separately, heads of household status, a qualifying surviving spouse filing with this status, and then we'll do a comparative analysis of all the five statuses, and then we'll also do some understanding of tax planning basis the concept of filing status, and then a quick wrap up slide and how we can apply the logical step by step framework to determine the filing status. So we'll move to the first slide and understand what is the filing status. Okay, so what is the filing status? So filing status is the legal classification of federal income tax purpose. It determines which tax rate bracket applies because once it has been determined that you have a particular filing status, that status will determine the tax bracket, the rate of the tax in which you will fall, the quantum of the standard deduction which would be applicable to you, what are the various tax credit to which you can apply the deductions, and what is the phase out limit for the deduction, and then overall tax liability effects. So which means that once it has been established what is your filing status, the next logical step would follow, which means that it will help us to understand which tax brackets an individual fall, what are the various deductions and credits that is available to that individual, what is the phase out limit, what is the quantum of standard deduction, and what is the overall tax liability effect. So filing status directly help us to understand the amount of tax that is payable by an individual. So the most important thing is that it is determined as of 31st December every year. So our filing status is determined on the marital status and the household situation on the last day of the tax year. So if you're married on December 31, you are considered married on the entire year. And if you're divorced by 31st December, it is considered you are unmarried for the entire year. So whatever status is prevailing on 31st December of a tax year, that will follow for filing for the tax return for that particular year. The filing status impact, it determine the various attributes of the tax. So we just discussed above that areas affected is tax bracket. Different income ranges taxed on the different rates, standard deduction, higher for a merit and HUH, credit eligibility, some credits limited for the married and filing separately. Capital gain threshold is different basis the status, and net investment tax threshold is also different basis the status. Example, some income different tax, same income different taxes. So for two individual earning the same income, $80,000, person A files as a single person, person B file as a head of the household. So person B may pay less tax due to the better brackets of and the higher deduction. So which means that same income uh, will have different tax liability and the consequences depending upon the status in which he is filing the return. And if he is filing the return in single category, then definitely state tax consequence will be higher. But if he is filing under the married and filing jointly or head of the household, then the tax consequences would be lower because lower tax liability would be there because the higher deductions would be available and the higher brackets are available. So we'll move to the next slide and quickly have a look at the overview of the various filing status. Okay, so before actually moving to the various overview on the various filing status, let us quickly spend some time in understanding why filing status matter. Because we understood that filing status helps us to determine the which tax bracket, which all deductions are applicable, what is the quantum of the standard deduction that is applicable, and what is the tax credits that are available and the final tax liability. So, why filing status exists? So, in the US tax system, adjust the tax burden based on the marital status, on the household responsibility, and on the dependent supported. So, these three are the factors which helps us to determine the filing status, and the filing status helps us to determine the tax consequences. So, the three factors that help us to determine the filing status is the marital status, household responsibility, and the dependent supported. The law recognizes that supporting a family changes the financial capacity. Filing status is not just a label, it changes how much income is taxed, at what rate it is taxed, how much deduction you can receive, and which credit you qualify for. So again, the conceptual understanding of filing status helps to determine the tax brackets, helps to determine the standard deduction, helps to determine the total tax credit a particular individual is qualify, and then definitely helps us to identify the total tax consequences. So the two taxpayer with the identical income can pay different taxes solely on the basis of filing status. And filing status influences the tax rate, it influences the deduction, it influences the credits, it influences the planning strategy, and definitely the overall tax outcome. So, having understood the concept of filing status, what is filing status and why filing status is there, let us spend some time in understanding all the filing status that are there, and then we are going to have a deep dive slide for each of the filing status. So, let's move to the next slide. Okay. Now, having understood clearly the concept of filing status, what is the concept of filing status and why it is required, let us understand the various filing status that is available to the individual taxpayer. And this is specifically for the individual taxpayer, not for the corporate houses, for where they have do not have these many status. They simply have to file the return as per their corporate status. Now, for the individual, why it is important that we have already understood that it is important because different tax filing status have different tax brackets, standard deduction, credit eligibility, and the income threshold. So, five status that are there is first is single, and it applies if an individual is unmarried or even after marriage, it is he's either legally divorced or separate, living separately, and divorced, legally separated, do not qualify for the head of the household, then he can file the return as a single taxpayer, a single filing status. Then we have the married filing jointly, which is MFJ, applies if married as on 31st December and both spouses agree to file the return together. Next we have is the married filing separately. It applies if married, but they have chosen of not filing the return jointly. They have chosen to file the return separately, and they will then file the return separately even after being getting married. Next is head of household. It applies if an individual is unmarried uh, and that individual pays more than 50% of the total household expenses and he has a qualifying dependent. Then he can file the return as a head of household rather than single because the benefits deductions and the tax credits available to the head of household is more is better as compared to the single filing status. And last one is qualifying surviving spouse. Applies to the spouse, applies to individual whose spouse died within last 2 years, and there is a dependent child to support. And then that person is not remarried. So that person can file the return in the category of qualifying surviving spouse. So what are the key takeaways? Choosing the correct filing status is critical because it directly impacts one's tax calculation. And the filing status determined separately for each tax year. This is very, very important. For each tax year, it has to be determined separately. It is based upon the marital and the household situation as exist on the 31st December of each tax year. Can change from year to year if the circumstances changes and eligibility is met. Only between the married filing jointly and married filing singly offer optional flexibility. So which means that an individual, a couple can, file their return jointly in 1 year, and then they can take a decision to file separately in the next year and vice versa. So this decision is optional. All the rest categories dependent upon the status which is there on 31st March, which is dependent on the marital status or the household status. Okay, so now having understood the all filing categories, which are 5 filing categories, we'll now do a deep dive of each of these individual filing tax categories. So we'll start with the single one. So we'll move to the next. Okay, so we'll talk about the first category, which is filing status single. So who qualifies as a single? So you must file a single if you are unmarried, most important, unmarried as on 31st December, legally separated under the state law, or divorced before 31st December, which means that you are not remarried or you are not married on 31st December. This is most important criteria to be ensured to have this filing status as single. Widowed and not eligible for qualifying surviving spouse. So which means that widows are there, but they are not eligible for qualifying surviving spouse and do not qualify for the head of the household. If none of the conditions are there, then individual can file the return as a single status. Status is determined based on the marital situation at the last day of the year. Important rule: if you are unmarried on 31st December, you are considered single for the entire tax year. This is very, very important. Even if you are married earlier in the year but divorced before the year end, that means you are single. So if you're single, this status is applicable to you. And what are the tax characteristics of a single status? The base level deduction is applicable. Standard deduction tax threshold are different. Full access to the most individual credit. Capital gain threshold lower than the married filing jointly. So as I mentioned earlier in the opening slides as well as in the subsequent slides, that the tax consequences are different for each of the filing status, and the more responsibilities individual have, the more benefits are available in terms of the deductions and the basis the capital gain tax bracket. For single, it is on the lower side, but definitely the deductions will improve and the eligibility for the capital gain threshold will be higher as we move forward for the married filing jointly or for HOH, which is head of household. When single may not apply, even if unmarried, you may qualify for head of the household or a qualifying spouse. So which means that if an individual is single, he can still option to file the return as the head of the household. This is the condition that he is incurring 50% of the more than 50% of expenditure for the household expenses, and he is a dependent he or she has to support, and for a qualifying survivor spouse if the spouse died within the last 2 years. So these may offer a better tax benefit. So individual may decide that which filing option he will wants to file. Even after the fact that he is single, he has still option to file as a HOH, which is household head of household, or the qualifying surviving spouse. So having understood the concept of single filing status, let us quickly look at the various tax credits and the benefits that are applicable for a single tax qualifier. So we'll move to the next slide. Okay. Now, having understood the concept of single taxpayer and then what all benefits accrue to that, let us quickly spend some time in understanding what all benefits or the deductions that is available. So what we have done, we have created a table here. We have put all the categories, which means that all the benefits, deductions, credits that would be available to individual, and then we have mentioned the limits or the thresholds basis which the deduction is available. we're not going to do the detailed analysis of what does each of this category means, because this would be going to get covered in the subsequent chapter, where we are going to discuss of each of these computer component, because this will help us to determine the final tax liability. So what we will then do, we'll quickly have a snapshot of all these items and see that how it is different from the various status. So when we talk about the tax bracket, so uses the individual progressive tax bracket, which is narrower as compared to the married filing jointly. Standard deduction is base individual standard deduction, which is lower than the married filing jointly or the head of the household. The rates of the tax that would be applied is the progressive tax rate, which means that increases the income, taxable income increases. Long-term capital gain threshold, which is lower threshold when compared to the married filing jointly. Net investment income tax. So this is another tax which is being imposed, which is over and above the income tax. And likewise, the additional Medicare tax threshold. This is available even if the individual has higher income for those for those categories. 2 lakh is the threshold for the single tax filer, and this tax limits or the threshold increases when the status changes to the married filing jointly or for the head of the household. Likewise, child tax credit available if the taxpayer is the qualifying child and meets the income requirement. Earned income credit available if the income is within the qualifying limits. So, in nutshell, all these benefits that accrues will depend upon the filing status. If the filing status is single, then the benefits would be on the lower side. But the moment the filing status move to filing married jointly and then head of the household, then they have the better applicable limits. And we are going to touch base of all these categories. What is the meaning of child tax credit, earned income tax credit, education credit, traditional individual retirement. We'll talk about all this in the next chapter when we are going to discuss upon the total computation of the income, and wherein we are going to use the various categories, because each category is dependent upon the threshold and the income brackets basis which the total limits will be available to an individual. So with this, we'll move to the next slide and look at the next status. Okay, so now we'll talk about the second category, which is married filing jointly. So who qualifies as married filing jointly is that you may file as a married filing jointly if you are legally married as on 31st December. You both the spouses agree to file it together, and one spouse died during the year, a special rule applies. So this is the conditions which needs to be compiled with before the status can be filed as married filed jointly. If married on 31st December, you are considered as married for the tax year. This is very, very important. So what does married filing jointly means? Which means that both spouses combine their income, both spouses combine deduction, one joint tax return is filed, and both spouses are jointly and severally liable for the tax. So which means that this is a very, very comfortable situation wherein both the individual are filing the taxes jointly. There's a single return filing for both the spouses. Both can file the return, both can claim the deduction, and this has a benefit where because the higher threshold limits accrue to them. Why MFJ is usually beneficial? Because merit filing generally provides higher standard deduction, wider tax brackets, higher capital gain threshold, greater eligibility of the tax credit, and the higher phased out limit. So, which means that if the deduction amount is more, let's say if one individual is earning more and another is individual is earning less, then instead of filing separately, when they combine their income and they file, then they can get the better standard deduction and the better other benefits that accrue basis the various categories that we discussed in the last slide. And we'll have a similar table being created for the married filing jointly. It is typically the most tax efficient status for the married couple. So spouse A earn $90,000, spouse B earn $30,000. Total income is $1,20,000. They can file one return combining the income and deductions, and they are going to get the better standard deduction when they file the return with the $1,20,000. So we'll go to the next slide and look at the same table that we saw for the single status in the last slide. We'll move to the next slide. Okay. Now we'll quickly have a look at the same table that we discussed for the single majority, and these are the same category. The point which needs to be noticed is that the net investment income tax the limit was 2 lakh there and it is 2,50,000 there. Also, the limits would be different for the standard deduction, for the child tax credit and the earned income credit. All this will be different as we move forward and see that these are different basis the filing status. But what exactly these are, we are going to cover separately as a part of the next chapter when we are going to discuss about the computation of the tax for an individual. But for the this particular chapter, the point that we want to make out here is that the various category of the like tax package, standard deduction, all these will differ as we shift from one status to another status of filing the return. So with this, we'll move to the third status, which is like merit filing separately. Okay. Now, this is the third status, married filing separately. What does this means that? This means that the individual are married as on 31st December of that particular year, but they have chosen not to file the joint return. Each spouse files their own separate return for that particular year. So marriage status is determined as on 31st December of the tax year. And what does married filing separately means that each spouse reports their own income, each spouse claim only their own deduction, two separate tax returns are filed, and each spouse is responsible for their own tax. Why MFS is often less favorable is because when compared to the married filing jointly, MFS generally result in the higher tax rate because it is like filing the two separate returns. Lower standard deduction because standard deduction is available to the joint standard deduction is not available because they're not filing it jointly. Limited tax credits available and lower income phase out threshold. It is usually chosen for a strategic or the legal reason, where and not for the tax saving. So people normally use it for a strategic and the legal reason, and there can be multiple reasons, and we'll talk about all these as we move forward in the next chapter in the series. So example, spouse A earned 1,50,000, spouse B earned 20,000. If they file separately, spouse A pay tax on 150 and spouse B pay tax on 20,000. Tax brackets are narrower as compared to the MFG. We'll move to the next slide and see the similar table based slide for all the tax categories and see that what will benefits accrued for merit filing separately. Okay, so again the same table here. The point which needs to be noted here are the 250 which was there for verified jointly reduced to 1,25,000, which is limit has been reduced to for each of the individual. And likewise, the benefits which accrue tax bracket is similar to single but less favorable in certain ranges, approximately half of the merit filing jointly. So all the benefits accrue would be reduced to 50%. State and local tax deduction, which was 10,000 in the merit filing jointly, it is reduced to 5,000 cap, which is half for the joint limit. Likewise, various other benefits which accrue would be either proportionately reduced or it would be applicable as of a single. So we'll move to the next slide and look at the next status, which is HOH. Okay, now this is an important category because this has a concept of wherein an individual is not married or status is not married as on 31st December, which means that is a single or either divorced, legally separated. And then he has a dependent to support and then he's spending 50% of his total income for meeting the household expenses. So who qualifies as a head of the household? You may file as a head of household if you are unmarried or considered unmarried as on 31st December, paid more than 50% of the cost of maintenance at a home, have a qualifying dependent living with you for more than half of the year. This is very, very important, which means that you have a qualified dependent and he is living with you for more than half of the year. If you qualify all this, then you are qualified to file the return as a HOH. So HOH is designed to benefit the single parent and individual supporting their dependents. So key qualification criteria are either is unmarried or legally separated, paid more than 50% for the household expenses, a qualifying child or a dependent live with you. Household expenses includes rent or mortgage, utilities, property taxes, food consumed at the home. And what we have done, we have created a table here to quickly list out what all is considered as the qualifying household expenses and what are not considered as the non-qualifying expenses. So rent payment, mortgage interest, property taxes, home insurance, utilities, electricity, gas, water, repair and maintenance, food consumed at home, homeowners association fees and basic home supplies. These are considered as the qualifying household expenses, and what are not considered as the qualifying household expenses are the clothing, education expenses, medical expenses, life insurance premium, transportation expenses, vacations, entertainment expenses, value of your personal services, and the personal grooming expenses. These are non-qualifying expenses. This is not the exhaustive list, but just to give you a flavor that what all constitutes as a qualifying household expenses. So, for example, a single mother earns $80,000, supports one child, pays majorly for the household expenses. So filing status is head of household and pay less tax as compared to single. So example, a total household cost is 24,000, taxpayer pay 14,000. So which means that he or she is paying 58% of the total expenditure, total income towards the household expenditure. Then this individual can file the return as a head of the household. So why HUH is beneficial? Because the head of the household provides a higher standard deduction than a single, more favorable tax bracket, better capital gain threshold, strong credit eligibility, and it is generally more tax efficient than a single status. So which means that a person who is single but he has a dependent to support, and that dependent stays with that individual for more than 6 months in that particular year, and then that particular individual is spending more than 50% of the total income for the cost of maintenance of the home and household expenses, then he can file the return as an HUH rather than a single to get the better tax advantage. Then we'll move to the next slide and look at the similar table that we have looked in for other three categories. Okay, so again, we have a table here, tax bracket wider than the single but narrower than the married filing jointly. Standard deduction higher than the single but lower than the married filing jointly. Tax rate apply, progressive tax rate, favorable tax brackets. So all the benefits are there which applies to the head of household. And we are going to talk about each of these benefits when we are going to talk about the computation of tax for each of the filing category, and that is part of the computation of the income which we are going to cover in the upcoming chapters. But for this particular chapter, we just need to quickly have a look at the various benefits that accrue to that for depending on the final filing status. So we'll move to the next. Okay, now we'll talk about the last status, which is the fifth one, which is the qualifying surviving spouse. So what does this mean? So who qualifies for a qualifying surviving spouse? Your spouse died within the last 2 year of tax year. You have not remarried and you have qualifying a dependent child, and you pay more than 50% of the cost of maintenance. So largely the same condition as that of the head of household, but the difference is that this is applicable for an individual whose spouse has passed away, and this individual is status is still filed as a qualifying surviving spouse. And one important point that is to be understood is that this is gender neutral category. Gender neutral means that a husband can file this category under this category if his wife has died in the last 2 years. Likewise, the lady can file or the woman can file if her husband passed in the last 2 years. So it is gender neutral concept, and the qualifying surviving spouse applies to both male and female. So this status allows surviving spouse to continue receiving the joint tax benefit temporarily. So this is a transition period wherein he or she can still claim the benefit of joint filing separately for 2 years. And once those 2 years are passed away or done away, then he has to choose as a status in which he has to file. If he is married after 2 years, then he can file as a filed married file jointly, or he can, if he want to choose the HUH, he can still continue to file as an HUH. So purpose of this status is the IRS provide the status to support the widows and the widowers, provide financial stability, allow continued use of the favorable joint tax rate. If acts or it acts as a transition period after the death of the spouse. So quick example here. So we have mentioned the duration of the benefit. Year of the spouse death files as a married file jointly. Next 2 years filing as a qualifying surviving spouse. After 2 years must file single or head of the household if eligible. So example, spouse died in 2024, taxpayer supports dependent child. Has not remarried as in 2024. So first he will file as a file jointly for that 2024. And then for 25 and 26, qualifying surviving spouse. And then 27 onwards, single or the head of the household. This is the qualification. So which is very important. So year of the spouse death is the year in which he can file as a married file jointly, even though that spouse died in that particular tax year. For next 2 years, he or she can file as a qualifying surviving spouse, and after those 2 years, he or she has to file as a HOH or singles depending upon the qualifying criteria. If is supporting the child and his total expenses toward the household is more than 50%, then he can file as an HUH. Otherwise, he can continue filing as a single. So we'll move to the next slide then. Okay, so this is the same table that we have discussed for all the category, and this is as for this chapter, it is largely for an academic purpose. We are going to touch base of each of these limits, and this is the filing status in the upcoming chapters. So with this, we actually cover all the five categories. Let's quickly have a look at all these five categories in the form of the comparative table. So we'll move to the next slide and see the comparative table. Okay, so this is the comparative table that we have created against with all these criteria, and we'll quickly have a look at this table that how it helps us to understand the filing status more appropriately. So, single married status is marital status required. It's single for unmarried. Married filing jointly, it has to be married. For married filing separately, again it has to be married. Head of the household, unmarried, and the qualifying surviving is widowed within the years. Dependent required, it is not required for single married filing jointly or married filing separately, but it is required for head of household and qualifying surviving, yes, child required. Standard deduction level is the base highest in the married filing jointly, lower than the joint for separately one, higher than the single for a head of the household, and the same as the joint. So, which will benefit of a joint married filing jointly and the qualifying surviving spouse are largely the same side. Tax bracket width is with narrow for a single, widest for the married filing jointly, same as the joint when we are talking about the qualifying surviving spouse, and it is narrower for married filing jointly and wider than a single. A long-term capital gains threshold lower, highest, lower, moderate, and same as joint. Net investment threshold again applicable for a high net worth individual. Additional Medicare tax again applicable for the high net worth individual or having the higher income. Child tax credit eligibility, yes, for a single if child exists. Marriage filing jointly, yes, it is there. Marriage filing separately, it's limited, and for rest of the two categories, it is yes. Earned income tax credit is yes, it is not allowed for the married filing separately, but it is just for the rest of the category. Education credit is yes for all the category except it is not allowed for the married filing separately. State tax and local tax deduction is for 10,000 for each one then, but for filing marriage separately it is 5,000. A joint liability risk is there only for one category, which is the married filing jointly, and then filing income threshold is base for a single. It's approximately double with the single, so double the single lower, and then definitely same as that of joint. And overall tax efficiency, it's moderate for a single, and it's most favorable for married filing jointly and a qualifying surviving spouse. So again, we are going to talk about all these in great detail as we move forward because each of these filing status has a separate tax planning altogether. We'll quickly spend some time in understanding the tax planning in this chapter as well. It's touch base on the tax planning, but deeper study would happen when we are going to discuss each of these status separately. So we'll move to the next slide and have a look at the some of the tax planning options that are available. Okay, now we'll spend some time in understanding some of the tax planning on basis of the filing status. We'll just quickly spend some time. Deep dive will definitely happen as we move forward. But let's say tax planning for a married filing jointly versus married filing separately. So when married filing jointly is better, definitely it's better because lower overall tax, higher standard deduction, access to the more credits, and higher capital gain tax. But sometimes merit filing separately seems to be a better option, specifically for those cases if one spouse has large medical expenses. So in that case, if we combine the income, then the percentage limit would apply on AGI, which will increase the overall medical limit and reduce the overall spend of the medical expenses. So which means that the credit would be of lesser amount, or it may be a situation wherein credit is not available because the AGI percentage which will apply on the AGI would be on more than the actual expenditure spent on the medical. So in that case, it is advisable to file the return as a merit filing separately. Student loan repayment planning. If let's say wants to have the lesser outgo in terms of the amount that is payable to the loan outstanding, then they have to file separately because if they combine, then the obligation to discharge the loan repayment would be more. So if they want to reduce the loan obligation on a monthly basis, they will file as a filing separately. Legal liability concern. So which means that we understood that the liability for the merit filing jointly is joint and it is separate for the merit filing separately. So if there is some legal liability on an individual, then it is always better to filing separately because otherwise it would be joint liability for both the spouses. Likewise, for if one spouse has a tax debt, then it is always better to filing the separately, because then it would be impacting that particular individual only and not the joint. Then head for the household optimization. If unmarried with dependent, HUH provides better tax bracket, higher standard deduction, and lower overall tax. Many taxpayers incorrectly file as single when HOH is available. So this is one of the main area to understand. If they are single, if they have a dependent, if they are spending 50%, more than 50% of the household, for the household spending, then they should consider filing as an HOH. Qualifying surviving spouse planning. So widower and the widowers should use the qualifying surviving spouse for 2 years after the spouse death, benefit from the joint tax bracket, and plan for transition to the HOH of the single. Capital gain planning, filing status effect, 0% capital gain on the threshold and 15 to 20% bracket, net investment income tax trigger. So all these are the factors which is considered while deciding the final status. Likewise, income phase out management. Credits and deduction phase out at different level depending on the state. For example, child tax credit, education credits, and all these credits are dependent upon the income phase outs, which means that if you reached a particular income limit, then these benefit would phase out. So we have to plan accordingly. If our benefits are getting phased out quickly, then we should consider it filing separately rather than filing jointly. Liability protection considerations. So MFJ, joint and several liability, both spouses are responsible for the entire tax. MFS, separate liability and useful in the high risk situation. So all these points needs to be considered basis the case to case, to then finally figuring out that what filing status needs to be chosen by an individual, and that will really help them to do the appropriate tax planning. So with this, we largely come to the end of this particular slide, this chapter. We'll quickly go to next slide and have a look at the summary and the key takeaways. Okay, so key decision and framework and the summary. So we'll quickly go over step-by-step decision making to understand that which filing status needs to be picked up. So step-by-step filing status decision guide. So before selecting a filing status, follow this structured framework. So step one, what is your marital status as on December 31? If you're married, then choose between the married filing jointly and married filing separately. But if you're unmarried, then we have to move to next step. Do you have a qualifying dependent? Yes, then check if you qualify for HOH. If no, filing status is single. Step 3, did your spouse die in the last 2 years? Yes, so check eligibility for qualifying for surviving spouse. And if no, continue with the applicable status. And if married, compare with the MFG versus MFS. So evaluate your total tax liability, credit eligibility, phase out threshold, medical expenses, other benefits that accrue. And then finally consider the tax planning impact. Review how filing status affect the standard deduction, tax bracket, capital gain threshold, net investment income tax threshold, credit phase out, and the audit and the liability exposure. So what we have learned in this chapter, we learned that filing status is determined as of 31st December. We learned that it directly impacts tax rate reductions and the credits. Married filing jointly is generally more or most favorable. Married filing separately often limits the benefit. Head of household provides the major benefit for single parent. Qualifying surviving spouse preserves joint benefits temporarily. Filing status is strategic tax planning decision and needs to be understood in detail while we adopt the final tax filing status. So with this, we'll come to the end of this chapter. We'll move to the final. Thank you. Okay, so with this, we complete one of the most practical and strategically important chapter in US taxation, which is filing status. Today, we learned that filing status is not just a formality on the tax return. It determines which tax bracket apply, your standard deduction, eligibility for the major credits, capital gain threshold, net investment income tax triggers, additional Medicare tax threshold, every exposure on your tax liability. We also saw how married filing jointly generally provides most favorable tax outcome. Married filing separately may be useful for liability or the strategic planning. Head of the household benefits a single parent significantly, helps us to reduce the tax liability. Qualifying surviving spouse provides temporary joint benefit, and single is the default status for unmarried taxpayer. Uh, in module 2, we have now covered who is required to file taxes, residential status, and the filing status. Now we understand who you are, who are you how are you classified, and which filing structure applies. The next logical step is to understand what income is actually taxable. So in the next chapter, we will begin exploring gross income concept, what is included and what is excluded from the taxable income. Because before calculating tax, we must understand the concept of what will be taxed. So with this, we'll move to the end of this chapter. Thank you for watching this video and watch our channel and wait for another video that's going to come very soon. Thank you and have a good day.